Welcome to the Best Interest Podcast, where we believe Benjamin Franklin's advice that an investment in knowledge pays the best interest, both in finances and in your life. Every episode teaches you personal finance and investing in simple terms. Now, here's your host, Jesse Kramer.
Hello, and welcome to episode 93 of the Best Interest Podcast. My name is Jesse Kramer. Later in today's episode, Joe Saul-Sehy is back. Joe from the Stacking Benjamins podcast. If you haven't heard of Joe, Stacking Benjamins is the best money show on earth, I think Joe calls it, because Stacking Benjamins, not only is it amazingly popular, not only does it have great guests, but Stacking Benjamins is always entertaining. I've been really honored that in some recent months, Joe has asked me to join the Stacking Benjamins Friday Roundtable to be part of the expert panel that they have on Fridays. And Joe and I have a really fun conversation today. It's going to be quite similar to episode 78, where I asked Justin Peters to come on the podcast, and he and I had a fun debate about what we thought are the most important rules of personal finance. Today, Joe and I are doing something similar. Joe came with a list, I came with a list, and we talked about what we think are the most important questions that someone should ask themselves as they glide into retirement. We didn't know each other's lists as we came in, but we went back and forth. We compared and contrasted what we thought were the top priorities for pre-retirees. What are the questions that they should be asking themselves? So it's a really fun conversation. But first, let's do a customary review of the week. This one comes from Pivot Points MD, who wrote in and said, Jesse is a change maker. He really does take tricky or complex topics in the personal finance arena and boils them down into digestible bites. He shows us how to eat the elephant in the room. I have had the good fortune to meet Jesse, and the content he produces, they are both top-notch. I'm an avid fanboy and urge you to become one too. He really does have your best interest at heart. Well, thank you very much, Pivot Points MD, for the kind words and the multiple food references in there. I saw that. Digestible bites. He shows us how to eat the elephant in the room. I like it. I like it. So Pivot Points, if you're hearing this, please send me a note to jesse@bestinterest.blog, and we'll get you hooked up with a super soft Best Interest t-shirt. Now, before Joe Saul-Sehy joins us today, I wanted to read to you from a recent article I wrote called Putting a Dollar Sign on Financial Planning. Considering we're talking about retirement planning today, which is certainly, I'd say, one of the pillars of financial planning, I thought this article would be pretty interesting to you listening today, because whether you're a dedicated DIYer or you prefer to lean on professional guidance, the truth is clear that smart financial planning can save you a lot of money over time. And in this article, and what I'm going to tell you today, I'm just going to share some recent examples of tactical planning moves that I participated in or that I noticed that other people should be taking advantage of. And I'm going to include today how much money was saved by these smart financial planning moves. First, we're going to start with the COVID panic. Back in March 2020, you could be forgiven for thinking that the world is ending and I want to sell everything. But with proper perspective and an investment policy statement, which are both hallmarks of sound financial planning, many investors stayed the course. They rode the stock market down more than 30% from peak to trough. Ouch, right? That must have been very hard for them to do. But then nevertheless, they rebalanced along the way, selling the more stable assets in their portfolio, like bonds or money market funds, in order to buy stocks. Now, that's not natural behavior, buying stocks as they decrease in price. In fact, I'd say it's the opposite of natural behavior, that the natural thing to do is to run away from the threat. Right? If stocks are falling, and if that hurts us to see that, if that's a threat to our mental stability to see our stocks fall, the natural inclination is to run away from that, to sell our stocks, to run away from that pain, right? To remove your hand from the hot stove. But the smart thing to do in investing is to run toward that threat, right? To buy more stocks, to rebalance into stocks as stocks drop. That's not natural behavior. That's learned behavior through experience, through education, through proper perspective, proper guidance. In the end, while others might have made portfolio mistakes during the COVID panic that cost them 10% or 20% or more, things that are probably permanent impairment of capital that can never be recovered from, the intelligent investor has a better portfolio now than if the COVID crash hadn't occurred because they rebalanced throughout it. So we should ask ourselves, what's the value of a 10% mistake on a $1 million portfolio? That's a $100,000 mistake right there. And as our portfolio continues to compound, the dollar value of that mistake is only going to grow larger and larger over time. Okay, a second example, which I call bring me a higher yield. A friend of the blog recently sold his successful small business here in Greater Rochester for about $10 million or so, which is certainly not your everyday event to be certain, but it's actually more common than I realized. I kind of had this interesting realization over the last couple of years of just everywhere you look, there are small and medium-sized businesses. A lot of them are more successful than you might think from the outside looking in. But anyway, I sat down with this individual just to spitball some ideas. And my honest advice to him was, hey, first, put together a financial plan, which would detail the future planned inflows and outflows of money from your family's financial ecosystem, which would, of course, include some very well-deserved near-term spending. You could even say splurging. I mean, hey, you just sold a business for $10 million. Do something fun with some of your money. But then once you have a plan in place, pick an asset allocation that corresponds with that plan and with the various timelines embedded in that plan, and then dollar cost average the money into that asset allocation. For example, it might look like 4 large tranches of investment over a 12-month period or something similar to that. Now, one of the problems was that the idea of investing $1 million into the stock market concerned this individual. And personally, I think good investing education is one way to solve that problem, but that type of education doesn't occur overnight, right? It takes a while, I think, for that to sink into someone where they say, okay, they start to trust, if you will, the stock market as a good long-term investment. Short of that, as we discussed next steps, I asked this individual, I said, where's the money right now, right? Where's the money right now? And the answer was, it was in a large U.S. bank that you all would have heard of in a savings account there, earning 0.05%. And that was the interest rate, 0.05%. And now the math there, on a $10 million deposit, 0.05% is about $5,000 in annual interest. So while we continued the long-term conversation about investing in the stock market, I gave him some important near-term advice. Seek out a higher yield via a brokerage money market fund. And in the 18 months since I gave him that advice, his average yield has been about 4.5% to 5% per year, or about $475,000 per year in interest on his $10 million deposit. So yes, a very simple tip to be sure, but sometimes financial planning is all about identifying the simple fixes in your financial ecosystem that, will provide $475,000 a year instead of $5,000 a year. Suffice to say, he bought my coffee that day. Don't tell Susie Orman. Okay, on to the next one, the car loan. One of my clients bought a new car a few months ago and came to me with a simple question. Should I take advantage of the 0% financing that the dealership is offering me? So the question there is, should they pay $40,000 cash out of pocket or take on a $40,000 loan with 0 interest? Now, the math here is quite simple. If this person takes the loan, they can keep their $40,000 in a high yield account, just like the one we just talked about, and earn something like $1,500 to $2,000 per year in interest with no downside, right? There's no interest on a loan accruing against them. So $2,000 a year, that's not life-changing money, but it sure is easy money. It sure is low-hanging fruit. It's a small, easy few percentage points that can move the needle over time. So again, much, much different than the $475,000 a year advice from the previous example. But hey, every dollar matters. Every dollar is fungible with one another. And would you say no to $2,000 a year in interest? I don't think so. Okay, the next little piece of advice, sneaking through the back door. Another client of mine, they came to me with the following details of their situation. They're a married couple in their early 30s. They're high earners. Their total income is over $350,000 per year. They're using their 401k accounts wisely, putting a lot of extra money after their 401ks into a joint taxable brokerage account. I asked them if they'd looked into saving money in an IRA. And they said, yep, we looked into it, but we earned too much money. And they were partially correct. They do earn too much money for normal IRA contributions, but they're the perfect candidates for backdoor IRA contributions. And I'll link an article here in the show notes that I wrote all about backdoor IRA contributions because they're now using backdoor IRA. And as long as the backdoor IRA remains open in the IRS code, because that's certainly a topic of conversation, who knows how long that option will be available to us. But I think we can conservatively calculate that for this couple, if they were to make backdoor Roth contributions for the next 30 years, and compare that to the alternative, what they were doing, which is putting the money in a taxable brokerage. I mean, in the Roth, of course, there's tax-deferred growth, and then there's no capital gains taxes when they withdraw that money eventually. So the question is, how much extra money will they save and earn over the next 30 years? I think it's easily in the 6 figures by utilizing a backdoor Roth IRA instead of putting the money into a taxable brokerage account. Again, not rocket science per se. A lot of people execute a backdoor Roth IRA on their own. There's a couple tricky parts to it, and you want to make sure you get it right. But that's the kind of thing that doing financial planning, again, whether it's working with a CFP or whether just being aware of all the available tools on your own, backdoor Roth IRA contributions can really move the needle over your financial lifetime. The next situation, which house should we buy? Another client of mine lives in the greater Washington, D.C. area, and with their growing family, they face a really interesting question. Where should we buy our forever home? There are three options, right? If you're not familiar, Washington, D.C. itself, Maryland, and Virginia, which are both right on the outskirts of Washington, D.C., they each come with their own financial pros and cons. And so we help this family weigh the following: the cost of the homes themselves, right? How far does their dollar go? The long-term cost of property and school taxes in those three different areas, the state tax benefits of home ownership in those three areas, the impact of state income taxes on their earnings over the coming decades, right? They're a high-earning couple. And Maryland versus D.C. versus Virginia will tax their income at different rates. So even though really what they're thinking about is buying a house, they also need to think about how will their income be taxed. And that's a really big part of this equation. And then the impact of, again, another state tax, capital gains taxes on their long-term investing, and the differences in capital gains taxes between Maryland, Virginia, and D.C. So, of course, this family, they should first and foremost pick a home that's right for their lifestyle, right? The finances should come second here, but the maximum versus minimum that we calculated puts their range of possible outcomes at a net present value of over $500,000. In other words, imagine House A for this couple. It's located in the most expensive locality for them in the greater DC area. And then imagine we pick up that same exact house in terms of, square footage and amenities, everything like that, and we place it in the least expensive area for them in greater DC. And then we look at how much those two houses will cost this family over the next 30 years. The most expensive area is going to be $500,000 more expensive than the least expensive area. That's their range of outcomes. It's a really wide range, and that's why it's important for them to factor this in to their question. So as always, we should ask ourselves, if they had an extra $500,000, how might that affect their lifestyle? How might their life's plans change with an extra $500,000? How much earlier could they retire? What could they do with that extra money? That's the fun part of financial planning. Our next topic, the value of a basis point. Now, portfolio reviews are a vital part of financial planning. And if an expert looks at your investments and says, you can accomplish the same asset allocation as you already are, but you could save 20 or 30 or 50 basis points if you do it this way. Now, what's the value of that recommendation? Now, quick aside, if you don't know, a basis point equals 0.01%, 1/100th of a percent. So 50 basis points, that's 50 hundredths of a percent or 0.5%, okay? Basis point, 1/100th of a percent. Smart, simple investing strategies don't have to be overly expensive. And so while professional financial planners do need to charge for their time and expertise, they can and should also save their clients money by keeping investing costs low. So the question is, what is a basis point actually worth? Imagine this simple scenario. An average investor, they might invest for 35 years during their life, putting away $10,000 per year and achieving a long-term average return of 8% per year. Throw that into a spreadsheet, pretty easy formula, pretty easy to do. An investor's final portfolio in that case would be worth $1.86 million, okay? Just shy of $2 million. And in that case, each extra basis point along the way decreases the final portfolio value by about $4,500. 11 basis points of difference, well, that adds up to $50,000. The lesson here is simple. Keep fees low where you can, and make sure you're getting value above and beyond the basis points that you're paying. Every single one counts. The next topic, what's a cash balance plan? Financial planning, as I've learned in my time, it's a deep subject area. There are a lot of different nooks and crannies that I haven't even heard of yet. You might have heard me here. I use the cave diving example, right? When you hear these stories of cave divers, they say, yeah, I'm deep down in this cave, and I realize, there's a fork in the road here in this cave that I've never explored before. And the deeper I go in the cave, the more options I find. And you realize that cave systems are vast and mostly unexplored. That's kind of how I feel about financial planning at times. Well, one example of this occurred earlier this year in 2024 when my colleagues recommended a cash balance plan to one of my clients. He's a successful solopreneur. Last year, he grossed about $700,000 in income, and a lot of those dollars obviously were taxed at the highest possible levels. His effective tax rate, total tax rate, was north of 40%. A cash balance plan, it's a defined benefit retirement plan, whereas a 401k is a defined contribution retirement plan. So in this case, it's a defined benefit, which in other words, it's kind of like a self-funded pension. Cash balance plans are especially beneficial when all of the following are true. We have a solo business owner or someone with a very small staff. The business owner has a high income and they would benefit from putting away more tax-deferred dollars. And the business owner is higher in age. As I'll explain in a minute, the annual contribution limits are very high for older business owners, and they aren't quite as high for younger business owners, which is why it starts to make more and more sense the older the business owner is. So in my case, this particular client can contribute about $200,000 into his cash balance plan this year, saving about $80,000 on his 2024 tax bill. And those savings, that amount of savings, is likely to increase every year between now and his retirement. Of course, kind of like a traditional 401k, he will eventually have to pay income taxes on those dollars when he withdraws them in retirement. But in the meantime, he benefits from tax-free growth, and more importantly, from the flexible and planned nature of his retirement withdrawals. In other words, a smart financial plan, a smart retirement plan, will plan his eventual withdrawals such that the rate of tax he pays is going to be much lower than the 40% that he's currently scheduled to pay. Right? He's saving 40% now to pay much lower than 40% in the future, and that arbitrage is money in his pocket. As I alluded to before, the tax balance plan, this is for 2024 limits. A 50-year-old can contribute about $200,000, a 55-year-old about $250,000, a 60-year-old over $300,000, and it goes up from there. So quite clearly, if you're an older solopreneur or just an older entrepreneur with a relatively small business, you can sock away a lot of tax-deferred dollars into a cash balance plan. The final example here, ugly annuities. I dove deep into annuities on episode 86 of the Best Interest podcast. In short, the vast majority of annuities are either vastly overcosted or disappointing in terms of return on investment. And for that reason, about 99% of us are best off never touching annuities in the first place. But what if you've already bought an annuity? What should you do then? As always, an essential part of financial planning is to let the numbers be your guide. Annuities typically have surrender fees, which charge the owner of the annuity an extra fee to exit the contract. These fees range from, say, up to 10% of the total annuity amount. So that's like a $100,000 fee on a $1 million annuity. But those surrender fees, they typically decay in size as the annuity matures. So it's common to see, for example, an 8% surrender charge in year 1 of the annuity, but it decays down to 0 surrender charge after year 10 or something like that. And again, here I have a client example working with a gentleman who owned multiple annuities at various maturity levels. We analyzed each one and showed him the potential upsides and downsides of dissolving those annuities, paying surrender fees, and then investing the proceeds into a moderate investment portfolio. And together we created a multi-year schedule to flip his portfolio to what I'm going to call here the light side of the force. And in the long run, say over the next 20 years, I can confidently say that he'll save 1.5% per year on fees. And then slightly more conservatively, I can predict that his new allocation will outperform the annuities by 3%, maybe even up to 5 or 6% per year, if I'm being a little less conservative. So he's saving on fees and he's going to get better performance, especially when we start to measure over a multi-decade time span. So on his $750,000 annuity portfolio, which is now flipped over to the light side of the force, over the next 20 years, those conservative saving assumptions between fees and extra performance is likely to lead to an extra $1.3 million in extra compounding in his pocket. So you see, smart financial planning, it's not about outperforming the stock market, right? It's not about finding the hot stock. It's not about options trading. It's not about Bitcoin. Instead, it's about identifying places in your personal or your family's financial ecosystem where you can and should be saving money, where you can and should be paying less taxes or earning better returns, reallocating assets, paying lower fees, taking advantage of special types of accounts, et cetera, et cetera. It's about knowing all the different rules of the game and then playing that game effectively. So this idea, or this little monologue here showed you just a few examples, whether it's avoiding panic in the stock market, earning higher yields on your money, on your savings, things like backdoor Roth contributions or cash balance plans, understanding the value of a basis point, optimizing a home purchase decision or a car decision, detangling ugly annuities, and the list goes on and on and on. Just a few of many examples, and none of which are picking the winning stocks. The real value of financial planning lies elsewhere. Here's a quick ad, and then we'll get back to the show. Every week, I send a quick free email to thousands of readers that shares 3 simple things. 1, my new articles and podcasts. 2, the best financial content of the week from all over the internet. And 3, a financial chart that explains some important concept in the news that week. It's a great primer to boost your financial know-how.
But Jesse, I don't want another email.
Well, this might not be for you, but I do hear you, which is why I make it very short, sweet, and full of only the essentials. A whopping 66% of subscribers read my email at least once a month. They're enjoying it, and maybe you will too. You can subscribe for free on the homepage at bestinterest.blog. Again, that's a free, no-strings-attached subscription at bestinterest.blog. And without further ado, I want to welcome Joe Saul-Sehy back onto the podcast. Joe originally joined us back on episode 73 of the Best Interest Podcast. And does Joe really need an introduction? I'll give him one anyway. Joe is the founder and the main host of Stacking Benjamins, one of the most popular financial podcasts in the world. Always entertaining, always informative. Stacking Benjamins, for what it's worth, I am an avid listener of Stacking Benjamins. I don't listen to every episode, though, because he puts out 3 episodes a week, which is amazing. But at least once a week, I'll see a guest, I'll see a topic, I'll just see something funny or entertaining that they're doing, and I'll tune in. That's the nature of Stacking Benjamins, and Joe and his team have been doing it for over a decade. So without further ado, here's Joe Saul-Sehy. Joe, thanks for stopping by the Best Interest Podcast, to be clear, the Best Interest Podcast. You're fresh off the plane, right? Are you calling in from the tarmac right now?
Almost. It was so fun. I went to South America, had a great time. I was telling you about this before we started recording. It was amazing. But the cool thing is they're very close to our time zone, Jesse. So I'm here. I'm wired. I've had a little bit of coffee. So let's bring it.
Very cool. And we are going to talk today, as we talked offline, it's similar to episode 78 for you listeners who listened to episode 78, where
my favorite episode.
Justin Peters and I compared and contrasted our list of the 5 golden rules of personal finance. And today, Joe and I are going to talk about the most important questions. We each brought a list of 5. The most important questions one should ask themselves as they glide into retirement. Some of these questions are probably going to be financial. Some of them might not be financial at all. Some of them might have to deal with how many trips you're going to take to Peru in your retirement. I don't know. That might be one of Joe's. It could be. In Justin's episode, we ended up deciding to start with our most important question, if you have ranked them by importance, Joe. And as the guest here, I think it's only fair that I let you go first.
Just so you can throw yours on top of mine and go, that stupid one. I got a better one, Joe. I got a better one.
I don't know if that's possible. But why don't you kick us off? What was either your number one or just the most important question that one should ask themselves as they glide into retirement?
Yeah, and generally, Jesse, when I do these, I like counting the other way. I like doing like the Dave Letterman style, if you remember that, like 5, 4, 3, 2, 1. But I like doing it this way for your particular list because mine all flow from this number one. Every single thing I bring up after this one is going to flow from number one because it solves so many problems when you focus on this first. So many people start with, what's the best investment I should use? When should I take Social Security? What's the optimal drawdown rate? How do I make sure that I don't get caught in a black swan event? Like, as soon as I get into retirement, all these big questions people have, one question you ask, one, that's it. And by the way, I want to clarify this before I even say it, and I do this to build dramatic tension, by the way, totally build dramatic tension. Just people like, just say it, Joe.
That's an experienced host right there. You've done this for a while, haven't you?
You're going to wait for it. But I'll say this. If you're 25, you're 30 years old, and you don't plan on retiring until 55, 60, 65, don't worry about this number one. But specifically, Jesse, because the homework you gave me was as you glide into retirement, this is super important. And it is this. What are you going to do with your retirement years? First of all, a lot of people don't even spend a lot of time on retirement. There was a survey once that showed that people spend more time planning a family vacation than they do planning their retirement. You're going to go on vacation for 2 weeks, maybe to South America, maybe have the time of your life. But then retirement, Jesse, it's going to be like 30 years. And what you do, the more things change over the course of my career, the more important this question gets. Like when I started back in 1993, things were all about the money. It was just about what funds do you pick, what's the money, what's the, how much Social Security are you going to get? It's all that. But it's funny how even on the Certified Financial Planner courses, they've added behavior to the game, right? And what we're learning more and more and more is if you only focus on the money in your planning, there's not only a good chance that you're going to get it wrong, there's also a good chance you're going to die sooner. Because if your goal is for a fulfilling retirement, it isn't about the money. It's about what are you going to do? How much life are you going to live? What does that look like? And so if you're gliding into retirement, I think you need to be crystal clear about what you want to do. And I get this all the time, right? I used to get this. I haven't been a financial planner. People don't know. I've been a financial planner a long time. But when I was, and I talked to OG, my co-host on Stacking Benjamins about this, people always say, I want to travel. I want to play golf. And then just poke my eye out with a pen. Because playing golf, can you play golf every day for 30 years? I had clients that said, I'd like to try. Like, give me a
few of them might, right? Maybe one or two.
But like 3 months into it, you're like, is this it? Well, and very seriously, this is the most common thing, according to a guy named Ken Dykewald, who studied for a long time longevity planning. 18 months in retirement, people go from a sense of euphoria to a sense of, is this it? Is this all there is? Really? And you know who those people are? Those are people that haven't asked themselves, what am I going to do in a much more serious manner than golf and travel? So I've got 4 more. But the 4 are going to spring directly from that. And these 4 become easy if you start with that really hard question.
I love that. And I will say that that's in the way I phrased it is, what kind of lifestyle do I want in retirement?
Yeah.
I think that's a very similar analogous question. And as you're explaining this, Joe, I think back to a few things that I've discussed before, just a few of my little lines that I like to drop on people, which is, if you're going into a regular weekend, you might not really plan for that weekend. If you're taking a 1-week vacation, though, you're probably going to do some planning. But retirement is almost like the weekend that never ends, or the vacation that never ends. And the fact that more pre-retirees don't spend more time thinking about it, which we know is true. You mentioned his last name was
Dykewald, Ken Dykewald.
Ken Dykewald. I hadn't heard of Ken. We'll try to find some of his work and link it in the show notes. I think a study that Fritz Gilbert helped put together, I think last year, in the last couple of years, which I've cited a few times here, the number one concern for pre-retirees tends to be financial. If you poll pre-retirees, they're worried about finances. But if you ask post-retirees, people in the first 3 or 5 years of their retirement, finances is usually not even in the top 5 because they've realized, their finances are okay. Now they're having some existential concerns about, right, is this it? Or the other analogy I think of is whether it happened to you maybe as a teenager going to college or maybe it happened to you as a college graduate entering the workforce, where you have some new freedoms. You have maybe more time or more money than you've ever had before. And we all know the story, or we know maybe even a person who they went to college and they kind of went off the deep end. They slept in, didn't go to class, they drank too much, they let themselves go a little bit. Hopefully, though, at some point, they kind of look themselves in the mirror and they say, okay, is my lifestyle finishing last night's beers every single day for the rest of my life and then dragging my ass to class? And like, no, you got to get your SHIT together and figure out what you're going to do. And I think in my experience talking to retirees, sometimes there's some of that, which is, right, the golf trips wear off, the beach days wear off, and there has to be a little bit more substance underneath. Do you have any specifics, Joe? Or, I mean, if I'm kind of trespassing on your other answers, don't let me. But any specific types of changes in thought process that come to mind where you entered retirement thinking A, and then after a year or two, someone starts thinking B?
I've got 3 different ones. You were on a recent episode of Stacking Benjamins where we talked about the idea of goal setting in general not being about the goal, but about it being a quest where along the way, the whole thing is this dramatic journey. I feel like too many people look at retirement as the finish line when it truly is in a lot of ways a starting line of a new quest, which means a few things. It's really disturbing. I talked to Christine Benz recently from Morningstar, and Christine said some things I think that will scare and upset people going into a retirement that is not real. which is it's important to still have an alarm clock. It's important to still get your butt out of bed. It's important to have goals and to have things that you're doing. And for most successful retirees, and this comes from Wes Moss, who wrote a great book about what the happiest retirees know, it is because you have so many other things that you want to do. It's just like, Jesse, it's like a different career, but it's a career. It's more of a Dr. Seuss, the places we'll go kind of career where we can do it now because we love it, not because we're financially committed to it. We now can get passionate about it. Speaking of Fritz Gilbert, by the way, this guy, for people in the best interest community that don't know Fritz Gilbert, like Fritz Gilbert, this dude definitely has an alarm clock. You can feel his sense of purpose. His wife is this phenomenal nonprofit they do with animals.
Fences for Fido.
Yes. Putting hours and showing up, quote, at work during your retirement, which means, Jesse, the more that you and I read about retirement research, the more we need to take the word retirement and kind of put it in the trash, because there's so many connotations that don't work if you want to live a long time, have a great existence, where retirement, that sitting back in a rocking chair, doesn't work for anybody.
Yeah. Post-employment. Well, maybe we'll have a competition. How about that? What if we do a joint competition to rename retirement? That could be fun. Anyway.
I want people to do the most ridiculous name, though.
Yeah. The Bodie McBoatface. Are you familiar with this story? Bodie McBoatface won the prize as the most popular name for some big auspicious boat. That's good. That's good. Let's go on to number 2, and I'll volunteer to go first this time, Joe, because after all, I'm thinking to myself, all right, this is a financial podcast. It's something that you and I share as a passion and something we love to talk to people about. And there are a ton of different directions that we can go for finances in retirement. And so I thought to myself of what's a relatively easy question, but also a question that's like an onion with many different layers that someone can ask themselves as they're gliding into retirement. And the one that I settled on is, what does a typical month of finances look like for me? A typical month of finances look like for me. And my thinking was that if somebody sits down and tries to answer that question, they will start to check off whether it's Social Security, whether they're collecting a pension, whether they're living off of some savings, whether they're pulling some money out of their investment accounts. It'll at least get their brain thinking, maybe they won't get to the black swan events quite yet. Maybe they won't have a efficient frontier, safe withdrawal rate, complexity stuff quite yet. But at least it'll get them moving in that direction of trying to understand all the various interplay of their income sources. And then, of course, what they want to spend in retirement, right? What their monthly expenses will look like. So this overarching financial question in my top 5 is, what does a typical month of finances look like for me?
Well, and I think the important thing that you nailed there, Jesse, is that just the exercise of sitting down and talking about what a typical month looks like kind of goes back to my number 1. It goes back to, okay, now that I've dreamed it up, let's put some numbers behind it. And I got to tell you, this is a little bit like putting on my running shoes. Let me explain what I mean by that. I've run 11 marathons, and still every day I really don't want to go out there and run. It just feels like it's going to hurt. It's not going to be any fun. Of course, once I get out there, it's great and it's fine. And I finish the workout and I'm happy I did when I finish. When you tell somebody, sit down and begin spreadsheeting out what your typical month is going to look like expense-wise, you're like, oh God, no. Oh, please. No. But just like putting on my running shoes, Jesse, once you get the spreadsheet open, you start doing it. Cheryl will tell you this. She's not a money geek like you and me, my spouse. Cheryl loves it when we have our weekly money meeting. Like getting the two of us to sit down and do it. Sometimes it's difficult, but we get into it for 2 minutes. And then next thing you know, we are both just nerding out on, oh yeah, look, Hulu's raising their prices. We just had our meeting. Hulu's raising their prices in a couple months and we have Hulu. So what are we going to do? We're going to keep it. And then the cool thing is this whole idea around what does a typical month look like isn't about the spreadsheet anymore. And we talk about Hulu. It becomes about value. Do I value Hulu enough to pay $89 a month? Like, do I really value Hulu that much, or is it time to look for a different solution? And when we get beyond the money to the value part, like, pow, I get super excited.
Yeah, agreed. I like that you brought up that when you started in the financial industry, what'd you say, 93?
93.
It really was just about the money. And over time, it has evolved to be more about some of the softer things. And one of those, I think, is those values, right? Is sitting down with someone and saying, well, you've got X amount of money. How are we going to align that with what you value, what you want to spend it on? And with retirement planning be this multi-decade period, it's just such a ripe opportunity to pursue the things that are most valuable to you. So to not answer those kind of questions early on, or at least to not go in with some sort of direction, right? It doesn't have to be forever. You're always allowed to change course. But to not have some direction up front is probably a mistake.
No, which is why it's so important to start with what you had as number one, right? I mean, your number two flows right from your number one.
Thank you, Joe. Thank you. How about you? What was your number two?
Well, believe it or not, mine does too, Jesse. Mine is not that far off yours, so I don't need to spend a lot of time on mine. Mine is, and from now on, all my 5 are organized as if it's a timeline. Instead of a finish line, I want people to draw out their life, and I want them to start drawing these events on their life, but also think about what you brought up. What's my average month look like? But then when am I going to need the money? My goal next is to figure out what streams of income do I have coming in? How do I want to spend my money based on what am I going to do? And once I've done that, then that's going to create these holes. And in those holes, I know I need to fill those in with the buckets of money that I've accumulated over my retirement, because it's super important to know when am I going to need that money. One of the things that frustrated me when I was a financial planner was when people would just think, well, I got X amount of money and I'm taking Y out per month, so I'm good. I'm like, have you ever done the math on this? Because this ain't mathing. This is going to run out faster than you think. And people are like, what are you talking about? It's only, I've got 80,000 left and I'm only taking out 2,000 a month. I'm like, yeah, but you're 64. It isn't going to last. It's not going to last.
The classic 20% per year.
Right? That's a withdrawal rate I could stand behind as long as you die very soon.
Right.
When are you going to need the money? Filling in and knowing what that deficit is now is going to drive the next 3 things that I wrote, because when you know what the deficits are like, you're going to know so much. And here's the thing. We often start off with the dream, and this is why this whole exercise, I think, scares people. We often start off with the dream, and then we get to this number 2, when are you going to need the money? And you realize, oh crap, I don't have enough. But what's cool is, Jesse, then we go back to what you and I were talking about with your number 2. Now we could talk about, what do we value in that vision that I built? How can I rearrange this so I get the stuff I value and I just eliminate the stuff that's nice, but it's not great? Or maybe I decide that I do want to keep, quote, working during my retirement years for a while. Maybe I want a part-time job. My father-in-law retired early. He didn't have any health insurance. He looked at health insurance. This is before the Affordable Care Act. And regardless of what the name is, health insurance across America, pretty unaffordable care. But he couldn't afford it before Medicare. So he loved kids. He didn't want to keep working in engineering. He got a job as a school bus driver because he got to spend time with kids, and he got health insurance. As a bus driver, he got health insurance working for the school system. So he found a creative way around his problem because he knew that he was going to need that money later, and he didn't want to spend it on healthcare today.
We've talked about it here on the podcast before, and it's gotten some positive and some negative feedback from experts out there. The idea of goal-based investing, which is a fancy way of saying, and the way I like to summarize it is, try to understand what your future financial needs are, try to assign dollars in your current ecosystem to those future needs, and then invest accordingly. And that I think is pretty similar to what you were just saying there, Joe.
How would you get pushback on that?
So the reason why is because it's funny. You and I were talking offline about some people who push back on other people's content. Well, that's not on the efficient frontier kind of criticisms. And essentially the criticism is that goals-based investing, this whole bottoms-up kind of investing approach, doesn't always mathematically lead to a perfect portfolio, and therefore it's somehow inherently flawed. To me, it's when someone says the criticism, it overlooks the behavioral aspect of this all.
It's actually funny, Jesse, you say that, because goal-based investing for me is the thing that saves your behavior. Because I'll tell you this, if I tell you you've got X amount of money and we don't put a ribbon on it that this is what it's for the second home, it's for that vacation, it's for this thing, it's for whatever, you effing touch it.
Right.
You go and you blow up your plan. But if I tell you, no, you need this money 5 years later from X, people don't care about the name of the fund. They don't care about the asset class. They don't care about anything about the investment. They care about their goal. And if I tell you this money meets this goal behaviorally, you're going to keep that money where it needs to be and leave your hand out of the damn cookie jar. Your hand's not going to go near the cookie jar. So that person is totally wrong. Jesse, you're the king.
No, it's true. I'm laughing to myself, not only because of what you're saying, Joe, but also it's this whole like, there are some people out there who, hey, respectful disagreements, I try to say, but it's almost like their approach is a little bit of investing for robots. Like you and here, we're here, Joe, and we're kind of thinking to ourselves, like, let's invest for humans. Like, sure, the math needs to make sense, but also like we want to think about the human element of this all. And there's some other people out there who are like, nope, investing for robots and don't worry about the mushy brain, just worried about the hard numbers.
I got another rant on this. One more.
Please, let's hear it.
When people in this community nitpick stuff like this, I'll tell you what it does to the average person who's just getting involved. It scares the hell out of them and they do nothing. It scares the hell out of them. And you know what's funny? That way directionally is correct. This way is directionally correct. I actually went after somebody on Twitter the other day because they were like, I just don't understand where asset-based management makes sense anymore. I just don't get the percent for asset-based management. And I wrote back, I don't understand why you as a certified financial planner are arguing over things that, yeah, might be important, like numbers 6, 7, 8, but there's a ton of people who will never go get help from anybody because you're scaring them with this BS. I saw somebody in a forum yesterday saying this target date fund has a 0.07% expense ratio. Is that high? I think I should get rid of it. I've never seen somebody not retire because of a 0.07% expense ratio. I've never seen anybody not retire, frankly, because of a 1%. 1%, you're pay 1%. You know what? Fees are important. And between two things, I want to keep my fees low. If everything else is equal, duh, that's what I want to do. But there are people who are trying to shrink everything. And when you don't have smart people around you, you kick your own ass. You do nothing. You got to surround yourself with smart people, and people nitpicking this crap drives me crazy.
You said crazy there, Joe, but I think what you meant was it just, no, I'm kidding. Let me nitpick your words. Can we have a semantic argument here? No, I couldn't agree more. And it is funny too. And it's sometimes I get sucked into certain pockets of the internet and I have to remind myself that, you know what, not everybody thinks this way, thankfully. And you're right. I've seen it on LinkedIn. I've seen people are now referring, they call it the fee wars. And what they're referring to is like CFP versus CFP arguments that go viral because all these other CFPs chime in, where one CFP is saying, I charge my clients $7,000 per year flat fee. And the other one's saying, I charge my clients, a 0.9% asset fee. And they have some giant argument about it. And it's like, guys, talk about like missing the forest for the trees.
Yeah, not to belabor this point, but I did see something that was pretty cool yesterday. At a spot I don't talk much about, White Coat Investor. I generally don't talk about that brand a lot, but he was talking about how they have recommended advisor lists on their thing, and they were kicking some people off because they charge too much. And I love his point of view. Jim's point of view, the White Coat Investor's point of view is like, listen, good advice costs money. Hiring good people costs money. He goes, but at some point it does, and I totally agree, at some point it does become prohibitive. He goes, I don't like cutting my grass, but if somebody's going to charge me $36,000 to mow my lawn, I'm cutting my own grass. And I thought that analogy is great, but it totally puts this argument where it belongs to, which is you should expect to pay smart people. We used to have this problem with charitable giving for a long time. In charitable giving, it was less money, less money, less money, less money. Then we figured out these charities are giving away all the money, but they're giving it away crappy places. You know why? Because none of the smart people want to work there. And all of a sudden you realize, I got to pay something for smart people so that we can be more effective. And you will be more effective if you pay the right people.
I hear you. The other example, why should I be 80% stocks in my portfolio? I feel like 75% is better.
Oh, God.
Okay, that's fine. That's like saying, why am I painting my wall off-white? I think cream is better. Yep, that's fine. Go ahead. You won't get an argument from me. Here's a quick ad, and then we'll get back to the show. A few of you occasionally inquire about two different topics that are actually related. The first type of question seeks out details about my professional life and the wealth management firm that I work for here in Rochester, New York. The second type of question involves the best interest, which operates with no advertising, no pushy sales, no paywalls. And the question is, how can the best interest stay afloat? Well, to answer both of those questions, I want to point you to episode 78 of the Best Interest podcast. I intentionally recorded episode 78 to shine light on those topics and inform you how you can actually help the best interest if you're so inclined. So if you've ever been curious about the business of the best interest, please go listen or download episode 78 and let me know what you think.
I think now it's your turn to describe your number 3 on your list.
So we start off building this timeline. What are we going to do with our years? And we're going to timeline that out. Then we're going to see where there's holes in the timeline. And then that leads to goal-based planning. That leads to what funds or what assets are you going to meet? This is a huge, huge problem that people have. Jesse, well, what's the good thing I should invest in? Jesse, this NVIDIA now, lately, it's been going nowhere. Like, what's going on with the NVIDIA train? It was going to the moon forever, and now it's kind of stalled. What do I do? Bitcoin, is that a thing? Should I get in there? Instead of asking these ridiculous questions, because there's so many different investments, we freak out about which one's the right one. And instead of doing that, we go, hey, I'm going to need this money probably in 12 years. It looks like I got this big hole 12 years from now. If I don't need this money for the next 12 years, and I know I'm probably going to eat year 12, where do I go? And we take this monster list of investment choices and we narrow it down to just a few. And now our evaluation process and the freak out factor goes from 1 million to almost none, because they go, hey, guess what? Instead of having to evaluate 300,000, we can look at these 5. And then we can decide how these 5 work. And then we know we have the appropriate vessel, the appropriate train to get us to where we need the money. So number 3 on my list is, what funds, assets are you going to use?
I love it. I love it. There's a cool stat that you might be familiar with, Joe, and listeners maybe are too. But I when it comes to this asset allocation decision, the stat is, and this comes from like the CFAs, the real nerdy investment minds out there, that basically 90% or so of someone's return can simply be attributed to the asset selection, meaning like stocks versus bonds versus pixelated pictures of cats and NFTs. I'm kidding. It was a serious point, except for the cat part. But then only the remaining 10% or so is, well, did you select a stock manager who's going to outperform? Did you end up just going with an index fund? What were the actual securities selected under that asset class umbrella? And generally, the way that I talk about things, whether I'm writing on the blog or speaking here, is exactly what you just talked about. As a retiree, that you're hopefully going to have 20 or 25 or 30 plus years of spending. And for some of those near-term years, well, it might not make sense to take a risk in the stock market to help support your lifestyle in 2025, because we don't know if the stock market will go up between now and 2025. So maybe for those near-term years, you want to lean more on slightly safer fixed income or cash or something like that. But once you get out into year 12, like you said, Joe, or year 15, whatever your personal risk measurement or risk appetite is, at some point it makes sense to introduce some higher risk, higher return investments. And just starting with that, you don't have to worry about picking NVIDIA or picking Facebook or picking anything else. Just start thinking about your overall asset allocation and how that meshes with your timeline. I think that's a great place to start. It's
wonderful. What's your number 3?
My number 3 has to do with health and healthcare. Because I just think that, if I had to put it into an actual question or an actual topic, it would just be, how will I manage my health and healthcare in retirement? Because I think all this conversation we're having, and just think about all the ink that's been spilled about retirement planning, and think about all the words that have been spoken about retirement planning and all the money that's changed hands when it comes to retirement planning. And then juxtapose that with the current state of the American health, not only health system, not healthcare system, but just Americans' health, right? The American food and fitness industries. And you realize there's something funny going on where we've got plenty of 65 and 70-year-olds who are financially prepared for retirement, and they are going to get sick and die very soon into their retirement, unfortunately. And it is a pretty widespread. You can use some flowery language here, and I'll let you fill in the blanks. But I think it's so important for people to, yes, you want to think about your multi-decade financial retirement and all the fun things you're going to do. And you also owe it to yourself to say, how will I increase my probability that I have a happy, healthy, that I'm there, that I'm living, and I'm vibrant during that retirement?
It's so frustrating to see somebody who did a great job with the money and they're not healthy enough to get any of those goals. Which brings up two things. Number one, if you're younger and you're listening to this idea of sabbaticals whenever possible is such an important thing because you have your health now. Do the things that you want to do now. Take a break and do those. Plus, part of that, Jesse, is also play testing. Maybe some other time I'll share my complete story with people about me being a nomad for a while, but I thought that was going to be my life. I was sure we sold our house. We sold all our stuff. We were going to go live. And then COVID hit. We looked at each other and said, okay, my wife was taking a job in Arizona. We lived in Michigan at the time. And it was funny. We were just waiting on one license she needed. And we get this call. There is no job because of COVID. And we'd already sold everything. We'd sold our house. We sold everything. And we look at each other. And this is the first time when I realized how cool financial independence is. Because we went from horrified, oh my God, there's no job, which would be 99% of us, to looking at each other going, wait a minute, you don't need to work. We can live where the hell we want. Like, where do you want to go? So we lived in Vermont for a month. We lived in Palm Springs for a month. Like, we spent most of COVID in these outdoor places, exploring national parks and trying to stay safe and away from people, do all the cool things for 2 years away from people. But I'll tell you, I hated it.
You're saying by the end of the nomadic lifestyle or kind of throughout it started to grind on you?
Yeah, probably by month 3 or 4, I was like, there's something missing here. I like slow travel. I will be okay during my quote retirement years when Cheryl decides she doesn't want to work. Because also during this process, we went through valuing work. And she said, no, I really want to work. I like what I do. I really like what I do. It's not about the money. And so she decided to go back to work. But when she decides to retire, Jesse, I like slow travel. We're going to go spend summer. It's hot as hell here in Texarkana in the summer. So we're going to spend 3 months in Portugal, or maybe 3 months back in Chile or Peru where I just was, or Vermont even. God, love Vermont. So, or Northern Michigan, which is amazing. Maybe go stay at Jesse's house in Rochester. Do some of that cool stuff.
We've got a little corner in the basement. It's a little musty and dank, but it's all yours.
Well, it's going to be perfect then because it's exactly what we have here, Mom's basement. So, but anyway, but back to healthcare, the fact that you play test stuff so you know what you like and what you don't like is super important. Sabbatical is super important because you don't know what your health is going to be like, but also then taking care of your health. And I found as I get older, well, I get frustrated that I can't do things the way that I used to. I can see my time slowing down. Speaking of running, like I just become happier as a slower and slower and slower runner. It still is really fun. The challenge of staying healthy is fun, but it's a mindset shift.
I like it. Let's go to number 4. Do you want to go first or do you want me to go first? Are we doing a snake draft?
I think we are doing a snake draft, which means you're up.
My number 4 is that a pre-retiree gliding into retirement needs to identify their important relationships and understand how they'll maintain those relationships throughout retirement. Because again, going back to some of the retirement research that I've read, a very common stressor or a common complaint or frustration that retirees have is the change, and usually it's the lack of the same type of social engagements and relationships that they had during their working years. That could be, I used to obviously know a lot of people at work, and I spent 45 hours a week at work, and now I don't see those people anymore. It could be I was participating in kind of professional or civic societies, whether, the Rotary Club or the Network After Work Club, and now I'm not doing that anymore. I used to work with clients, and I'm not doing that anymore. Now it's, no offense to my spouse, it's just me and my spouse all day, every day. That's a very common frustration. And going back to what is the Harvard Grant study, the longitudinal happiness study that's very famous. And one of, if not the biggest outcomes from that study is that human happiness is directly correlated to our relationships. And when our relationships suffer, we tend to suffer as social animals. So I think it behooves any pre-retiree to understand how their relationships will ideally flourish throughout their retirement.
It's a harder point than I think a lot of people think it is. And as a guy who's in his mid-50s, let me tell you, I see friends falling into this trap already. I have 2 friends that within the past 5 years have bought a, quote, vacation house away from all of their friends, and they increasingly spend more time at the vacation house because you know what, Jesse? You get to a certain amount of money, you get to a certain point of your life and you go, I deserve it. But the thing that they're really doing is isolating themselves from those communities. I love board games, so I have board game nights fairly often. There's one dude that I've forgotten to invite a few times because he's isolated himself so much. I didn't do it to him. He did it to him. But the cultural expectation is this is good. If I told you, oh, this guy's got this beautiful property on a lake about an hour and a half away and he spends a lot of time there and it's up on a hill and he's building this gorgeous, huge, like 4,000 square foot house, like it's gorgeous, unbelievable house on top of this hill, just looking down the spine of the lake. It's beautiful. You would think, everybody would think, well, yeah, it's retirement vision. That's great. It's horrible. It is medically going to make him die sooner. I've got another friend who is retiring and chasing his children. Chasing your children, I don't think is horrible. But what I've found is I've been around people that are on the other end of that. Once the kids get past high school, your kids kind of look at you and go, yeah, thanks. Yeah, okay. Don't need you around anymore. I have one friend of our families who moved from Michigan to California to take care of her grandkids. After her last grandson graduated from high school, she, within 6 months, moved to Virginia to be with other family. And during that whole time, think about how hard it is to get friends, especially for men. Like studies show men have a hard time making friends after age 35, 40 years old.
It's the only reason why I podcast, actually. I need to invite people. I mean, this is my social engagement right now, Joe.
He needs a buddy. It is so difficult. So I think that's an issue. The other issue, there's one more. I know people in their 70s. There's a guy who's a wonderful podcaster. I love him a lot. But the thing that I hear people say about him is, this guy's in his 70s. What the hell is he still doing working? What's funny is, Jesse, I want to be that guy. I can't imagine not doing this 20 years from now. Cheryl and I said that if we go live in Portugal for 3 months, I'm taking my podcasting stuff with me. I'm going to find a place with fast internet. I'm going to do, because I love it. But it is the first thing people ask about this guy all the time. They're like, does he not have enough money? So these cultural things of, I deserve the vacation house, I deserve to stop working, are actually the lifeblood for the guy still working. It's his lifeblood and he's great at it. Why the hell should he stop? Because he's 75. Why should I go isolate myself from my friends because I'm nearing retirement age? I think we have to carefully re-examine those things. So I love the fact that you brought that up.
I agree with what you said. And not only because you agree with me. It's not just pure confirmation bias speaking. I actually agree with what you said there, Joe. What's your number 4?
My number 4 is very similar to your number 3, which is how are you going to protect yourself? Ooh. How are you going to protect yourself? Now, you've got illness on just the everyday end to if I pass away and I'm married, what's my spouse going to do? If my spouse passes away, what am I going to do? Do I have my estate plan set up? Have I thought about long-term care? Long-term care is such a big problem. This idea of I'm going to have a catastrophic illness at some point. What's my strategy? Think about this stuff early on. Think about it once, develop your plan, and don't sit around worrying about it. But the problem I saw when I was a financial planner, too many people in their retirement years sitting around worrying about this stuff without a plan. Create your plan, live with it, have fun. Like go do your thing, go do whatever your mission is, but don't worry about all that stuff. Frankly, This should have been my number 3 because I agree with this client that I had. She was an engineer for the state of Michigan. And she told me when we were talking about protection, right? We're talking about insurances and having a big enough cash reserve in our estate plan. She said, I like this because as an engineer, when we're building a new highway, the first thing we do is we look at everything that could go wrong. And we protect against all those things. Like we on a whiteboard, try to make sure we've covered everything. And once we know we have a plan for all this, then we start building. But I think that narrative-wise, thinking about what funds or assets first goes along in people's brain easier. So really, before you start investing in funds and assets, you should figure out how am I going to protect myself and then do it. But narrative-wise, I think number 4, I like this better.
It's scary to think about. And so we're not wired to ask that question, well, what if I die sooner than I expect? What if something terrible happens? What if I fall off? What if I become like those what if questions, the scary what if questions that as you alluded to, your engineering client, I mean, I can certainly relate to that. As in my former engineering career, absolutely. What kind of things do I need to design for, and what factors of safety do I need to include, and what don't I fully understand? What are the unknown unknowns? Can I try to figure that, all that kind of stuff? I think it can be scary for the average person to commit a lot of their brain power to those questions, because it's really not fun to think about. And not to belabor the point, not to steal the spotlight, but that my number 5 is, it's worded a little bit differently, but it's what legal or estate planning do I need to do? Am I all set on the legal estate planning? And I should throw insurance in there too, if that's a need for someone gliding into retirement. Because if you haven't thought about it yet, I mean, I feel a little bit behind. I'm in my mid-30s, and I think there are some things where I ask myself, boy, have I really set up my family as optimally as I should have? Probably not. Because you never know when that plane is gonna land on you on the highway. Inside joke right there. You know, if you haven't thought about it by the time you're 50 or 55 or 60, and you're going into retirement with a partner, or if you plan on leaving money behind to your heirs, or whatever those kind of questions are, it's really time to get all of those affairs in order.
100%. Absolutely 100%. It's so funny how closely our lists align.
It's either great minds think alike or fools seldom differ. It's one of the two.
Could be one of those.
So that was my number 5, and that completes my list. But what's your number 5, Joe?
My number 5 is for all the snarky people out there, because money podcasts tend to attract money nerds. And money nerds are like, oh yeah, done all those. I'm good. And you know what? Generally, I think it's not great somebody doing what you or I do, or back when I was a financial planner, to be snarky. But this is the one spot where I get snarky, where I'm like, oh, good for you. Good for you that you're going to be okay. Boy, I bet you feel great, don't you? And people might be wondering, why the hell, what's that about? Here's the deal. You know, when we look at things like the efficient frontier as an example, and we look at organizing your assets better, people that listen to this type of show, usually people are pretty damn good at this. And when we're suboptimal with stuff, we let it go because I'm going to be okay. And yet you think about those people around you, those communities around you, you could do some serious good in your own backyard, whatever that means to you, whether it's your immediate family, if it's your kids, if it's your social organizations. You talked about communities. While we fight more and more online about politics, you know what's happening? Community organizations in our backyard are shrinking. Nobody's going to the Kiwanis Club anymore, helping out their organization. Nobody's going to the Rotary Club anymore. I go and I speak to these organizations about trails, which is what I do in my backyard, make walking trails around Texarkana. Mm-hmm. Our mutual friend, Chad Carson, does the same thing in Clemson. It was funny when we found that out, that we're both passionate about walking trails in our town. Like, we both are on boards for those. So I work a lot with the Parks Department, but I'm on this group of just citizens that build matching gifts for more walking trails and beautification. Safe routes to school with kids, great place to work out. But these communities need your help. And you know what's funny is when I started getting involved with community stuff, I realized that I should. And I thought as a financial planner, it'd be good marketing, just getting to know people, because you always see the movers and shakers in a town do this stuff, right? And I thought it was all marketing. I realized I wasn't really particularly passionate about anything. Like, I had no real goal. I had no cause. I had no whatever. So I just picked one. Frankly, I picked one at the time that my client was the head of the Arthritis Foundation. My mom has arthritis. My grandmother had really bad arthritis. So I did stuff with the Arthritis Foundation. Instead of waiting for passion to hit you, just go get your hands dirty. And when you go and you get involved and you see what the need is, then all of a sudden you're 100% on it. And now any way that I can use my money and my brain and whatever to help the people in the community around me grow, it sounds like I'm like Joe Humanitarian, some mug who's just, doing great. It isn't. Jesse, this is completely selfish. I will tell you, you will feel so kick-ass if you get more involved and if you help out. So if you're feeling okay after Jesse and my list, well, good for you. Great. Now go do something. You know what I mean? So it is snarky, but I think there's a wealth of knowledge that gets wasted. And I'll tell you specifically who I'm talking to. I'm talking to people that read J.L. Collins' book, The Simple Path to Wealth. They put all their money in VTSAX. They know nothing about either goal-based investing, the efficient frontier. And I will tell you that strategy is beatable by a lot. And if you have more than $70,000, $80,000 sitting in VTSAX, you're doing it wrong. I mean, just quite frankly, you're doing it wrong. And you missed the point of the book. The book was, hey, you're young. Stop freaking out about what to invest in. Just invest in VTSAX and you will become wealthy. And he's not wrong. He's 100% right. It's a simple path to wealth, not the optimal path to wealth, not the best path to wealth. J.L. Collins, smart dude. He didn't name it any of those things. He named it simple. And I see otherwise brilliant money nerds get caught in this trap of sub-optimization, which is so easy to beat. They'll have a budget that is unbelievable. They will have the right insurances exactly mapped out. And then it comes to their asset allocation and they crap on it because of a book J.L. Collins read that they misinterpreted. Anyway, another rant. Sorry.
Yeah. No. Oh, understood that. And that's another, you want to talk about like some nitpicking arguments that I've decided to avoid now. I mean, that's a big one. It's hard having an actual cohesive, coherent conversation with someone who's really drinking the VT Kool-Aid, as it were.
Well, they don't get the point.
Correct. Exactly. The whole missing the forest for the trees thing again. And it's funny, as you were describing some of the ways to give back to your community, I thought just this past week, have you heard of Paychex?
Yes. The company, payroll. I used to use them.
So founded here in Rochester, New York by a gentleman named Tom Golisano, who is a multi-billionaire. I think he's a multi times over billionaire at this point. I think he's probably in his 80s. Called a surprise press conference last week. It was actually kind of cool, thinking about cool ways of doing things. He invited all these people to a room. They didn't know why they were there. They were starting to look around the room and they realized like, wait, I'm the head fundraiser for this nonprofit. You're the head fundraiser for that. Like everybody in here was a fundraiser for a nonprofit. Then who walks on stage? Tom Golisano. Whoa, big surprise. Gave away $360 million.
Wow.
To like 40 or 50 organizations in, $1 to $20 million chunks. So this huge monumental thing that affected a lot of organizations here in Western New York. And he always has been very philanthropic in that way. But I think that's the kind of thing, of course, most of us listening are not going to be able to give away $360 million. But you probably can look at your financial plan. You can look at how it will change over time. You can start giving away money. You can just give away your time and effort, which is something you alluded to, Joe. And speaking of, when you come stay in the basement here, Parenton, New York, my little suburb, is a Trail Town USA designee. I don't know if you're familiar with this, but there's something like 50 or 100 trail towns in the U.S. that have a very high concentration of walking trails.
It's fabulous.
Great. It's great. You're going to love it. You can bring your board games. We'll put you in a tent down in the basement. You bring your walking shoes. You can walk all over. I won't drive you anywhere. I swear. You can do all the walk. No, but it is something that, and talking about making people happy, giving people purpose. I mean, putting your time and effort and resources to use in retirement generally is something that brings people a lot of joy. And it is something worth thinking about ahead of time. Well, Joe, here we are. The end of the episode. Thank you so much for coming here on the Best Interest Podcast. I mean, how can people, let's say someone's been living under a rock. They heard of me because I'm there under the rock with them, but they haven't heard of Stacking Benjamins. What's going on over at Stacking Benjamins these days?
Oh, we got this guy who's appearing quite a bit on our Friday roundtables lately. Some dude named Jesse Kramer, mixing it up with Paula Pant from Afford Anything and our own OG, Josh Bannerman, who's my co-host. And we have these great roundtable discussions on Friday. Mondays, we have Mentor Mondays. We have great people. We just had a great professor on from Stanford University. We have Seth Godin coming up, the marketing guru. We got Josh Brown, downtown Josh Brown coming on. So for people that know CNBC or people that know great financial planning people, Josh is going to be coming up. So we have great mentors on Monday, people we really respect. Wednesday, we take a headline and we go deep with it. We just talked about the Dallas Pension Fund, Firefighter Pension Fund. And we use that as a case study on a Wednesday show about how these big pension funds even mess up their money and how easy it is to do. Here's what they did, Jesse. They're like, we're not going to pay pros. We're going to put firefighters on the pension fund. And these firefighters invested in vacant land, swaths of land in Wyoming, and they invested in wineries in California, mostly, I think, because the wineries sent them on due diligence. Imagine if you told your spouse that we get to go to a due diligence trip with a winery, and you're sitting back there over, you're half drunk and you're looking out over you're like, we should invest in this.
Can't go wrong.
Those are mistakes a pro wouldn't make. Correct. And so while it doesn't need to be made by a pro, we kind of teach people in these case studies on Wednesdays to think more like a pro. And then on Fridays, we have a great roundtable discussion about some great topic. We've talked about, is DoorDash killing the community, neighborhoods, and our wallet at the same time? That's number one. We talked about, instead of goal setting, should we be going on quests? Having a lot of fun there. So Monday, Wednesday, Friday, the greatest money show on earth because it's a circus, the Stacking Benjamin Show.
It is. It's always entertaining and always enlightening. And I mean, I'm definitely going to check out Josh and Seth, two people who I have a ton of respect for. What can I say? Thank you again, Joe Saul-Sehy of Stacking Benjamins, for stopping by, sharing your time and expertise and your smile and your laughter with us on the Best Interest Podcast.
Thanks a ton, man. You and I have so much fun.
Thanks for tuning in to this episode of the Best Interest Podcast. If you have a question for Jesse to answer on a future episode, send him an email at jesse@bestinterest.blog. Again, that's jesse@bestinterest.blog. Did you enjoy the show? Subscribe, rate, and review the podcast wherever you listen. This helps others find the show and invest in knowledge themselves, and we really appreciate it. We'll catch you on the next episode of the Best Interest Podcast. The Best Interest Podcast is a personal podcast meant for education and entertainment. It should not be taken as financial advice and is not prescriptive of your financial situation.